We had a move, went up to $200 in early 75, as soon as we opened trading on the futures, dropped down to 103 by the summer of 76. Okay, summer of 76 to early 1980. Went from 103 to 850. You do the math, eightfold, okay? Go back to 2000. Gold made a reaction low at about 260. Over the next 11 years, it went to 1920, almost an eightfold move. Okay, so when you look at a log scale gold chart and you see these ratio moves, well, if we went up eightfold, it'd be $8,000 gold. And that would be merely replicating the two prior bull markets. She's not pounding the table and saying, oh, we'll do it again. Well, we don't have a do it again situation here. We have fundamentals and dynamics that are far more beneficial for gold and disastrous for other assets that could drive gold a lot further. But I'm not going to project where it could be. When I mentioned $8,000 gold in multiple interviews over the last year, it's not like I'm predicting that. I'm just simply saying if it merely did what it did before, it'd be $8,000 gold. And that wouldn't be off the page. It's hard to come up with a number. I do think, though, it should be speedy. In other words, I think a lot of it could occur if the stock market starts to break in the first quarter coming up and you start to get that money flow. A lot of this could occur during the next year. And ultimately, the government doesn't control things. I mean, it likes to nudge things, poke things. Hopefully, the Fed likes to think they can take this price, hold this price level steady in this category and let that one go down. They don't like commodities going up. That kind of inflation is bad, but they don't mind when inflation drives stock prices up because they don't call that inflation. And yet it's nothing but a river flow of money they created. It went somewhere else other than the commodity. Right. Well, that flips. You go back to the late 70s, we were in a recession, stagflation. Fed raising rates dramatically in the late 70s. Commodity prices were exploding. Well, the stock market was a total wasteland. No, they didn't explode as much as gold, but they went up strongly with gold. And I think this time around, they're set to go with the next power leg in gold. I think commodities are set to participate. And they've not always been in sync with gold at all. Sometimes they're quite opposite. In fact, over the last couple of years, gold doubled from 2015 bear market low to 2020, doubled in price. During the same years, Bloomberg went down. When did Bloomberg explode? After gold had peaked and went sideways, Bloomberg then exploded. Okay, totally out of sync. The last couple of years, Bloomberg's drifted down, about a 50% correction back to its bear lows and then gone sideways. Gold's gone up. But I think they're now set technically to hold hands and go together. Why? Primarily because the money will flow out of the massive asset category into that which is perceived to be low risk, higher reward, period. Gold is not some headline chasing market. In fact, if you sell gold or buy gold based on some kind of war news or the election outcome news, that kind of thing, you're stepping into it, okay? It's likely to blow up in your face. So if you shorted after Trump got elected, you're losing in gold, as much as $100 right now. So you don't do that. Gold moves on broader glacial reasons. And again, look at an M2 chart, go back 50 years and take a look. The gold will oscillate that money growth, but it'll stay in tune with it. They degrade the money, gold's going up. And if they have more excuse to degrade the money because they need to hopefully stop price collapse in this sector or that sector, banks, financials, commercial real estate, they'll do so. When the chief beneficiary is the monetary metal, because it is money. And it's been that way for 3,000 years. We may have forgotten about it, but a lot of the world hasn't. And I think suddenly when the American public, which is not at all bullish on gold, despite its strength year to date, they're not pounding the table. There's no fever in the gold market. That's when you'll see gold start to go more parabolic. Instead of like 3 steps up, 1 step back, it's going to be more like 6, 8 steps up, 2 steps back. And silver will be even more exaggerated. It goes up 4 and drops back 2. It's a bloody market. Yet year to date, silver's up, about as much, if not a little more than the S&P. In fact, 3 days, maybe it'll be up more than the S&P. So it's not a loser from an investor's perspective if you get in at the right spot. That's what I'd be looking for. And I think it is smart money. Obviously, somebody's buying it. And it's not just the Chinese. There are large American investors who've been buying into that sector.
Yeah, the Trucellas and Costco buyers.
Well, not just them. Large investors who are buying into the mining sector. Now, the mining sector is really a dog. Okay, now you can say that. What a dog. Gold's above the 2020 highs. It was just 2070, right? Mid 2070 was the summer of 2020. We're now 2,640. Okay.
Gold has always been a bedrock of wealth preservation, its value transcending time and trends. Michael Oliver's analysis delves into the reasons behind its steady and deliberate rise, highlighting its distinction from headline-driven markets. Unlike equities or bonds, gold operates on broader economic undercurrents that reflect the degradation of fiat currencies and the long-term trajectory of money supply. Historically, gold has acted as a barometer for monetary health, maintaining its purchasing power even as fiat currencies erode under inflationary pressures. Its value lies in its ability to oscillate with the growth of the money supply, staying in tune with economic realities, rather than succumbing to fleeting market fluctuations. The 1970s offer a crucial historical parallel. During this period, stagflation, marked by soaring inflation and stagnant economic growth, dominated the financial landscape. The Federal Reserve raised interest rates dramatically, yet commodity prices, including gold, surged in response. Gold's role as a hedge against economic instability became evident as it climbed to unprecedented heights, reinforcing its reputation as a safe haven asset. Fast forward to today, and the conditions mirror that era. Central banks are once again grappling with inflation, monetary debasement, and economic uncertainty. As policymakers attempt to manage these challenges, gold is set to benefit from the inevitable reallocation of capital from overinflated asset classes to more stable and reliable stores of value. The disconnect between gold's performance and public perception is striking. Despite its impressive gains in recent years, the American public remains largely indifferent. This apathy contrasts sharply with the increasing interest from institutional investors and central banks worldwide. Large American investors have begun buying into the gold and silver mining sector, recognizing its potential for substantial returns. While gold has surpassed its 2020 highs, the mining sector remains undervalued, offering a unique opportunity for those willing to look beyond traditional investment vehicles. This overlooked sector could see a significant influx of capital as the broader market falters, further amplifying the upward momentum in gold prices. Silver, often referred to as gold's volatile companion, deserves special attention. Its dual role as a monetary and industrial metal positions it uniquely in the market. While its price movements are more erratic than gold's, silver has historically outperformed during bull markets. The current gold-to-silver ratio suggests that silver is undervalued relative to gold, presenting a lucrative opportunity for investors. Additionally, silver's growing industrial demand, driven by advancements in renewable energy and technology, adds another layer of support to its bullish outlook. The broader financial landscape paints a compelling picture for gold's continued ascent. The everything bubble, fueled by years of easy monetary policy, is nearing its breaking point. Central banks' attempts to sustain asset prices through quantitative easing and low interest rates have created unsustainable valuations across equities, real estate, and bonds. As these bubbles begin to deflate, investors will inevitably seek refuge in gold. The metal's historical resilience during periods of market turmoil underscores its role as a reliable hedge against systemic risk. Central banks' aggressive accumulation of gold further validates its importance. Countries like China, Russia, and India are leading the charge, viewing gold as a strategic asset amid declining trust in the US dollar. The reclassification of gold as a Tier 1 asset by the Bank for International Settlements highlights its growing relevance in the global financial system. This shift marks a return to gold as a cornerstone of monetary stability, paving the way for its reestablishment as a key reserve asset in the evolving economic order. Gold's ability to withstand and thrive in adverse conditions is a testament to its enduring value. Unlike speculative assets, which rely on market sentiment and liquidity, gold is a tangible asset with intrinsic worth. Its scarcity, universal acceptance, and historical significance make it a cornerstone of financial security. As the global economy faces unprecedented challenges, from inflationary pressures to geopolitical tensions, gold's role as a safe haven asset is more critical than ever. The ongoing shifts in the financial landscape are creating a perfect storm for gold to reclaim its rightful place at the center of global finance.
Meanwhile, the gold miners, using GDX, for example, which is not necessarily the best metric, its high back then was $45. Right now it's trading 34, 35. So yes, it's up year to date, a nice percent. Not as much as gold or silver, by the way. But it's not got a fever in it, that's for sure. And we're arguing that you got to watch that dog sector, because once you break the stock market, there are investors who are not going to go out and buy silver bullion or futures contracts or triple long silver and bullion ETFs or anything like that. They're going to buy stocks And some of these stocks have decent dividends, by the way. And so they're going to move out of this stock and into these stocks. And they're going to move into that gold mining sector. And it won't take a heck of a lot of money flow to bloat that sector off the page when suddenly you get public interest in it. I think it could be far more dramatic than anybody can technically project, and far more rapid. Once the stuff starts to unravel that we've been talking about, that will fuel gold. And once it becomes almost the sole good alternative, and people suddenly realize, my gosh, it's been a better place to be actually year to date, and I'm all fevered over this market and wasn't fevered over gold, and yet gold beat them, and nobody's pounding the table. Then suddenly it starts to go vertical because the river flow of liquidity. And that's where you want to be. Now, where might gold go? Well, if you go back and since it was legalized, 75, we had a move, went up to $200 in early 75, as soon as we opened trading on the futures, dropped down to 103 by the summer of 76. Okay, summer of 76 to early 1980. Went from 103 to 850. You do the math, eightfold, okay? Go back to 2000. Gold made a reaction low at about 260. Over the next 11 years, it went to 1920, almost an eightfold move. Okay, so when you look at a log scale gold chart and you see these ratio moves, well, if we went up eightfold, it'd be $8,000 gold. And that would be merely replicating the two prior bull markets. She's not pounding the table and saying, oh, we'll do it again. Well, we don't have a do it again situation here. We have fundamentals and dynamics that are far more beneficial for gold and disastrous for other assets that could drive gold a lot further. But I'm not going to project where it could be. When I mentioned $8,000 gold in multiple interviews over the last year, it's not like I'm predicting that. I'm just simply saying if it merely did what it did before, it'd be $8,000 gold, and that wouldn't be off the page. So, you know, it's hard to come up with a number. I do think, though, it should be speedy. In other words, I think a lot of it could occur if the stock market starts to break in the first quarter coming up, and you start to get that money flow. A lot of this could occur during the next year.
Gold's current trajectory, often overlooked in mainstream financial commentary, speaks volumes about the seismic changes happening in global finance and geopolitics. As the economic foundations of fiat currencies continue to erode, the world is turning to gold as both a hedge against instability and a cornerstone of future financial systems. The unfolding scenario is a clarion call to investors and nations alike to reevaluate gold's role, not as a relic of the past, but as a vital asset for the future. Gold is unique among assets because its value transcends mere market speculation. Unlike fiat currencies that rely on government promises, gold is free from counterparty risk. Its intrinsic value has been recognized for millennia, making it a store of wealth across civilizations and epochs. Today, as the global economic landscape becomes increasingly volatile, this intrinsic value is coming into sharper focus. Gold's role as a monetary anchor remains as relevant now as it was in ancient times. Michael Oliver's insights emphasize that gold operates on broader, more stable forces rather than reacting to transient news cycles. Its movements are tethered to the monetary expansion of global economies. When central banks print money in response to crises, be it financial crashes, pandemics, or geopolitical conflicts, the purchasing power of fiat currencies diminishes. Gold, in contrast, retains and often increases its value, providing a counterbalance to inflationary pressures. The more money is printed, the stronger the case for gold becomes. The financial markets today are riding a wave of artificial liquidity. Over the past decade, central banks have pumped trillions of dollars into the global economy through quantitative easing and ultra-low interest rates. This influx of cheap money has inflated asset bubbles across equities, real estate, and bonds. Yet these bubbles are unsustainable, and cracks are beginning to show. As Michael Oliver points out, the impending collapse of these bubbles will create a ripple effect across markets. Historically, when financial markets enter bear territory, gold often diverges from the trend. During the 2008 financial crisis, for example, gold initially dipped alongside other assets but quickly rebounded and surged as investors sought safety. Similarly, during the dot-com bust of the early 2000s, gold began its bull run, ultimately reaching $1,920 per ounce in 2011. These historical precedents underscore gold's resilience and its ability to thrive in times of market turmoil. Today, gold is positioned for a similar trajectory. The everything bubble has reached a tipping point, and the eventual correction will drive capital away from speculative assets toward safer havens like gold. This shift will be amplified by a growing recognition of gold's value as a hedge against both inflation and systemic risk. While gold often steals the spotlight, silver plays a critical supporting role in this narrative. As a hybrid metal with both monetary and industrial uses, silver offers unique opportunities for investors. Its price movements are typically more volatile than gold's, making it a high-risk, high-reward asset. However, this volatility can be advantageous in a bull market. The current gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is historically high. This suggests that silver is undervalued relative to gold. When the ratio normalizes, silver's price could see significant gains. Moreover, silver's industrial applications, particularly in renewable energy technologies like solar panels and electric vehicles, add another layer of demand that could drive prices higher. Despite gold's rising prices, the mining sector remains undervalued. Companies that extract gold and silver are trading at valuations that fail to reflect the upward trajectory of the metals themselves. This disconnect presents a unique opportunity for investors. Historically, mining stocks have outperformed gold during bull markets, offering leveraged exposure to the metal's price movements. The underperformance of mining stocks can be attributed to several factors, including investor skepticism and past mismanagement within the sector. However, many mining companies have since restructured, improving efficiency and profitability. As gold and silver prices rise, these companies are well positioned to deliver substantial returns. For investors seeking exposure to the precious metals market, mining stocks offer a compelling alternative to physical bullion. One of the most significant trends underpinning gold's rise is the unprecedented level of central bank buying. Countries like China, Russia, and India are leading the charge, amassing gold reserves at a rate not seen in decades. This trend is not merely about diversification, it is a strategic move to reduce dependence on the US dollar. The weaponization of the dollar through sanctions and trade restrictions has accelerated this shift. Nations are increasingly wary of holding assets that can be frozen or devalued by foreign powers. Gold, with its universal acceptance and intrinsic value, offers a solution. By accumulating gold, central banks are not only hedging against currency risks, but also preparing for a potential overhaul of the global financial system. The reclassification of gold as a Tier 1 asset by the Bank for International Settlements, BIS, further underscores its growing importance. This move elevates gold to the same status as cash and government bonds, making it a cornerstone of central bank reserves. The message is clear. Gold is no longer just a hedge. It is a fundamental component of global financial stability. The US dollar's status as the world's reserve currency is under threat. Decades of monetary expansion coupled with rising geopolitical tensions have eroded trust in the dollar. The creation of alternative payment systems by nations like China and Russia, along with the rise of digital currencies, is chipping away at the dollar's dominance. Gold stands to benefit immensely from this shift. As trust in fiat currencies declines, gold's role as a store of value will only grow. The metal's scarcity and universal appeal make it an ideal candidate for anchoring a new monetary system. While the timeline for such a transition is uncertain, the trajectory is unmistakable. Gold is reclaiming its place at the center of global finance. Michael Oliver's projection of $88,000 gold may seem audacious, but history offers precedents for such dramatic moves. During past bull markets, gold has demonstrated its ability to achieve exponential gains. The drivers of these past surges, monetary debasement, geopolitical instability, and declining trust in traditional financial systems, are more pronounced today than ever before. For example, between 1971 and 1980, gold rose from $35 to $850 per ounce, a 24-fold increase. Similarly, between 2000 and 2011, gold climbed from $260 to $1,920 per ounce, a nearly 8-fold gain. If gold were to replicate these historical patterns, the $88,000 target becomes less far-fetched. While such a scenario would likely require significant economic upheaval, the possibility cannot be dismissed. The current environment presents a once-in-a-lifetime opportunity for investors. Allocating a portion of one's portfolio to gold, silver, and related assets is not merely a defensive strategy. It is a proactive step toward financial resilience. As the global economic landscape undergoes seismic shifts, those who position themselves early will be best placed to navigate the turbulence. Gold and silver offer more than just financial returns. They provide peace of mind in an uncertain world. Unlike stocks or bonds, which are subject to the whims of markets and governments, gold and silver are tangible assets with intrinsic value. They are the ultimate insurance policy against economic and geopolitical instability. As we stand at the cusp of a new financial era, gold's role has never been more critical. It is not just an asset. It is a statement of financial independence and a hedge against the uncertainties of the modern world. The forces driving gold's rise, monetary debasement, geopolitical tensions, and declining trust in fiat currencies, are not going away. If anything, they are intensifying. For those who understand the dynamics at play, gold represents not just an opportunity, but a necessity. The time to act is now, before the broader market wakes up to gold's potential. As Michael Oliver and other experts have pointed out, the next leg of gold's journey is likely to be swift and dramatic. Those who position themselves today will be the beneficiaries of this historic shift.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.